All right, in this video, what we're going to do is take a break from stock analysis of individual companies or whole sectors, and I'm going to show you one method to compute what's called the intrinsic value of a company. So the intrinsic value is what a company's probably actually worth based on some projections. So Warren Buffett famously said, price is what you pay, but value is what you get. So if a company's trading for, let's say, $200 per share, is that too much for that company? Is it too little? Is it a steal deal? Is it a super bargain? We would like to know that because we want to make informed decisions. We don't want to follow trends. We don't want to follow hype trains. We want to know, is this company a bargain right now, or should we not buy it at all? Maybe if we have it, if it's way overvalued, maybe we should sell it, take some profits. So I'm going to show you a sheet and a way of doing that with PE ratios, earnings per share, and projecting that out into the future, and then scaling that back with a discount. So here I have something called ticker, and we're going to analyze Microsoft in this video. So I put MSFT, that's the ticker for Microsoft, and we need three values. We need the earnings per share, we need the current price of the company, and we also need the PE ratio. Now, what is earnings per share? Earnings per share is how much money they make in profit and earnings per share, okay? So for example, for Microsoft, this is $14.06. So what that means is if you own one share of Microsoft, that company, Microsoft, has gotten you $14.06 in profit, okay? If you own two shares, then it's double that. If you own 10 shares, it's 10 times that. So Google Finance can actually pull that number for us. We don't have to go searching for it. So in cell B3, I'm going to say equals Google Finance, and I'm going to click on the ticker that I want to look at. I'm not going to put in Microsoft. I want to tell Google Finance, I already put the ticker in. That's Microsoft. So I'm going to put B1 there. I'm going to hit space, and I'm going to tell it what I want. So in quotes, I'm going to put EPS. That attribute will search the internet. It will find Microsoft's earnings per share, and it will report it right here. Okay, $14.06. Now that is a price, so I'm going to click on that cell, and I'm going to hit this dollar sign just to emphasize that is money, $14.06. Now what's cool is I can change the ticker. I could do Google, $10 even for Google. I could do Costco, $18.21 for Costco. So this spreadsheet will now automatically fill in my earnings per share depending on what company I put in. I put in Microsoft, so that's what we're going to go with. It will also do the price. So if I hit Google Finance, this ticker, comma, now I could put in price like I did, okay? And this will tell me the stock price for Microsoft per share. It is $491.02 at the time of this recording. So I'm going to hit the dollar sign to emphasize that that is money. But the thing is, if I had just left this second slot in this function blank, it would still give me $491.02. The default attribute in Google Finance is the stock price. So you could put in price if you want, but price is the attribute that is the default attribute in Google Finance. And the last thing that we need is the PE ratio. So I'm going to say equals Google Finance. I'm going to click on the Microsoft ticker, and in quotes, I'm going to put PE, the price to earnings ratio. Remember what PE is. PE is, for example, for Microsoft, it's about $35. What that means is you are paying Microsoft $35 right now for them to earn you $1 in profit, okay? And that might be really high, that might be really low. It depends on the company. It depends on what they've done historically. It depends on the sector, the industry that they're in. So 35 might be kind of high, and that's some useful information that you'll have at your disposal. Okay, so there's things that Google Finance can find for us. There's things that Google Finance cannot find for us. For example, the earnings per share growth over the next 5 years. Okay, now this got a little wide, so I'm going to go up here and I'm going to double click on this spot. That's going to automatically widen out my cell, my whole entire column here. And so earnings per share growth, this is where the art and the science of predicting intrinsic value comes into play. We don't know. This is sort of predicting the future, and nobody knows what the future has in store for us. So this is based off of educated guesses. This is based on research. This is based on what analysts say, what you find listening to conference calls. But this really is just kind of predicting what's going to happen, which is not easy. It's actually quite hard. So I'm going to say 15% for Microsoft based off of what I found online. You can go to Google Finance, or I'm sorry, Yahoo Finance. You could go to finviz.com, stockanalysis.com, just to get an idea. And what this 15% means is not 15% over the entire 5 years. This is 15% every single year for the next 5 years. That's what analysts expect on average. Okay, so we're going to put 15% there. I'm going to put, this is something unique to me because I like to be more cautious and conservative with my stock picks. I'm going to put a scale down factor, and I'm going to call that 1, and I'll explain what that means in a bit. I'm going to need a terminal rate, and I'm going to call that 3%. Now, what the terminal rate is if this company were to continue forever, they're probably not going to always grow by 15%. So mature companies basically grow with inflation. Around 3% is what we'll call it. So the terminal rate is sort of like, if it goes on forever, how much will they grow every single year? 100 years from now, 5,000 years from now, we'll call that 3%. We also need something called the discount rate. Okay, the discount rate is what we think the future returns should be, and we're going to scale that back. So we're going to call that 8%. 8% is generally what the stock market returns before dividends. And for healthy, mature companies, 8% to 10% is usually what you want to use. You want to use something above 10%, like maybe 12 or 14% for riskier, less solid companies. Okay. So we have pretty much everything that we need for our intrinsic value calculation. So I'm going to go to cell E2, all right, and I'm going to put in a 1. This is 1 year into the future, and I'm going to tell it, Google Finance, take that number and add 1 to it. So now there's a 2, just because I'm lazy and I don't feel like doing all those calculations. And I'm going to go all the way here to 10, okay? So I'm going to go 10 years out into the future. Now I'm recording this at the very end of 2025. So I'm going to put 2026 here for 1 year from now. I'm going to say equals this number. Google already knows what I want to do. I want to take that number and add 1 to it. As I undo it. So 2027, I'm going to click and drag, and it will autofill my formula all the way to the year 2035. Okay. So again, we're trying to predict what's going to happen in the future, and this is not going to be an exact science. So we're going to bake in some caution. We're going to bake in, what if we're wrong? What if this is too high? What if there's a recession? What if there's a war? All sorts of things can happen in the next 10 years. So what we're going to do is we're going to project the earnings per share. Okay. So we expect for the next 5 years for Microsoft earnings to grow 15%. Okay. So the way I'm going to do that is I'm going to say this equals this number right here times, now I want to grow it 15%. So I'm going to do 1 plus 15%. Okay. If I only multiplied it by 15%, by 0.15, that's actually shrinking it by 85%. By adding 1, you're saying it is what it is right now, $14.06, plus an additional 15% on top of that. So I'm going to hit enter, and I get $16.17. And your spreadsheet might just not have a dollar sign. So if it doesn't, you just click here, you click on this little dollar sign, it will automatically say this is currency. Okay. So what do I want to happen next? Well, I want to look at this cell right here, and I also want to grow it by 1 plus 15%. Okay. Now, I don't want to have to do that for all 10 years. And so now that this is in cell F4, what I'm going to do is I'm going to put dollar signs around the B7. Okay, in front of the B and in front of the 7. And what that's going to tell Google Sheets is when I click and drag this, I want to change what the previous cell is. You'll notice that this is looking at cell E4, right? The previous year's earnings per share, projected earnings per share. But I always want to grow this at 15%. And so what I'm going to do now is click and drag this, and this will predict what my future earnings per share will be all the way out into the future. Okay, so if I click on year 6 right here, 2031, you'll see that it's referencing cell I4, $28 and something cents, but it didn't change the 15% right here. Okay, it's growing at a constant rate of 15%. So that's just a quick and easy way of filling out your formulas. But this is where the scale down factor comes in. Okay, the scale down factor, we are expecting 5 years growth. 15% for the next 5 years, but 6, 7, 8, 9, and 10 years, we don't know, 15% might be kind of optimistic. So here's where I like the scale down factor. So what I'm going to assume is years 1 through 5, it's going to grow by 15%. But 6 through 10, it's going to grow a little bit less than that. So I'm going to go to year 6, 2031, right here. In this formula, I'm going to say that $B $7, I'm going to multiply it by what's in cell B8, and I'm also going to put dollar signs around that. Now you might be thinking to yourself, you're just multiplying it by a 1, what's the big deal? Okay, let's click and drag this over. Okay, because I'm going to assume, well, maybe it only grows 80%. Okay, 80% growth, all of a sudden you'll notice that these went down, right? Watch these cells right in here. Okay, it was a 1. It ends at $56.88 per share. But if I make it a 0.8, it ends at $49.84 per share. And the reason is this scale down factor says we're not earning 15% growth anymore for years 6 to 10. We're actually earning whatever 15 times 0.8 is. Okay, so it's actually, I think that's 12%. So it sort of bakes in a little bit of caution, and we can be really cautious. We can say, you know what, earnings per share growth might actually get cut in half, in which case you can see that we go 30, 40, 32, 68, all the way to $40.60, right? It was, with a 1 in there, $56.88. At 50%, it's going to go from $56 to $40. So this is just a way of baking in a little bit of caution. I'm going to keep this at 0.5 just to be very careful and assume years 6 through 10, it's not growing 15% anymore. It's actually growing half of that at 7.5%. Okay, so now we need cell what is this? O2. We're going to put in TV for terminal value. Okay, now what is that terminal value? The terminal value is we're going to take this $40.60. Okay, so I'm going to say equals whatever's in this cell right here. Now I'm going to divide it by something. I'm going to divide it by parentheses, the discount rate, which is 8%, minus the terminal rate, which is 3%, and I'm going to close those parentheses. Okay, so what this is going to say is if this company grows forever and ever and ever, it's going to be earning $811.98 per share. Okay, but that's in future dollars. All right, so inflation always makes things more expensive. If you had $100 in the year 1950, that could buy a lot of stuff. $100 today can't nearly buy as much stuff as it could in 1950, let alone like 1990. So what we need to do is we need to compute how much is $800 or $811.98 worth today. Now that's 10 years out into the future. So what I'm going to do is I'm going to say equals, I'm going to take this number, I'm going to click on the cell, $811.98, and I'm going to divide it by, and I'm going to put 2 sets of parentheses there, 1 plus my discount rate. Okay, my discount rate is 8%. And I'm going to raise that to the 10th power because we're going 10 years out into the future. Okay, so in the future, it's $811.98, but today that is worth $376.11. Okay, so that's what I'm going to do for years 10, 9, 8, all the way back through 1. So I'm going to say equals, I'm going to take this $40.60 that it's going to earn in the year 2035, and I'm going to divide it by parentheses 1 plus my growth rate, or I'm sorry, my discount rate, which is 8%, close parentheses, raise that to, now I'm going to click on this 10 up here because I want that number to be 9 when it's in year 9 and 8. I want that number to always change. Now, what do I not want to change? I don't want this B10 to change. I always want this to be 8%. So I'm going to put dollar signs in front of the B and in front of the 10. And we can see that $40.60 in 2030 is worth $18.81 in today's dollars. Okay. And we are going to scale this back all the way back to year one. All right. And you'll notice that, let's click on year six, $19.16. If I double click on it, it's taking $30.40. It's dividing it by 1 plus my 8%, which is what I want it to do. And it's raising it to the power 6, which is in cell J2. So for year 6, it's doing 6. For year 5, it's raising that exponent to 5. So this is doing exactly what we want it to do. Okay, so we can predict all their future earnings per share, but that takes, those are inflated numbers. And so we're going to scale it back to today's dollars. All right. And so now here in cell A12, I'm going to put intrinsic value. How much is this company supposedly worth in today's dollars if this is what the company is expecting to do for the next 10 years? So I'm going to say sum, and I'm going to highlight everything here, years 1 through 10, and also its terminal value in today's dollars. Okay, so I'm going to add those all up. So cells E5 through O5, I hit enter, and I get $556.22. Okay, now if we look at today's share price at the time of recording this, that is $491.02. So it seems like we have something that's worth $556, but it's selling for $491. That seems like a really good deal. How good of a deal is it? Well, right here, we're going to compute what is called the margin of safety. Okay, I always like to bake in a margin of safety. I think it should be worth $556 right now, but I could be wrong because all of these numbers could be wrong, right? These are all numbers that I am using for predictions, and I'm just kind of making this stuff up. So what if I'm wrong? Okay, what if it's actually worth $550 or $520 or $500 even? So in all those cases, I would be correct. But what if it was $485? Well, now all of a sudden, 485 is smaller than 491, so I'm actually paying too much. So it's always nice to have a margin of safety. So to compute the margin of safety, I'm going to say equals, parentheses, I'm going to take the intrinsic value, I'm going to subtract what the current price is, I'm going to close my parentheses, and I'm going to divide that by the intrinsic value, and this will give me a percentage. Okay, so I'm going to click on that cell, I'm going to go up here to percent, and I'll just do 1 decimal place. So if Microsoft is trading for $491 and I think it's worth $556, that's an 11% margin of safety. Now, maybe you really want to buy Microsoft and you feel comfortable with a margin of safety of 11.7%. I like margins of safety to be around 20% or higher, but if you're comfortable with that, then that's ultimately your choice. And so with these numbers, we might say that Microsoft is a buy with an 11.7% margin of safety. Now, I'm going to call this row right here present value of the earnings per share, just so we remember. And since you've made it this far in the video, I'm going to give you one more little bonus on evaluating and valuing stocks. And that is, I'm going to project the earnings per share over time. Okay, so not earnings per share, I'm sorry, the PE ratio over time. So currently, Microsoft is trading at a PE ratio of 34.93. Okay, now is that good or bad? Well, what I've done here is I've gone to stockanalysis.com and I pulled up all the sectors and all their current PE ratios. As a matter of fact, here on stocks on stockanalysis.com, we go to by industry and then you can find the sectors. And so this will show you the average dividend yield, the average market cap, or for our purposes, the average PE ratio. Now, Microsoft is in the technology sector, and that's trading for a PE ratio on average of 42. Now, remember, the lower the better. So the technology sector right now is trading at 42. Microsoft is at 35. So when compared to its peers, Microsoft right off the bat seems like it's cheap. Okay, but the technology sector has seen a huge boom with AI and advanced computing and quantum computing and all this. And so people are willing to pay a higher premium, a higher PE ratio for those companies. So then the question is Is 42.16 high or low for technology? Well, what I did is I used AI in Google and I asked it, what is the technology sector's historical PE ratio? And according to Gemini, long term, it's about 21. Okay, so the technology sector has historically been between 20 and 25, and we're currently at, what was it, 42? So that kind of suggests that right now technology is, it's, people are excited about it. It's driving valuations up. And so Microsoft is currently trading at a PE ratio of about 35, which is much higher than the historical average, but it's lower than the sector right now. So basically what I want to know is if I buy a share of Microsoft today at 491 bucks, what's the future PE ratio going to be? Okay? And so what we're going to do is we're going to take the earnings per share, which is $14.06. Or actually, what we're going to do is we're going to say equals. We're actually going to manually compute the earnings per share, or rather the PE ratio. So I'm going to take the price, which is in cell 491.02. I'm going to divide that by, all right, so what I'm going to do is I'm going to take the earnings per share, which is $14.06, and I'm going to grow that by 15%. So I'm going to multiply that by parentheses 1 plus my 15% growth that I think is going to happen. I'm going to close those parentheses, and I'm going to raise that to the first power because it's 1 year into the future. So I'm not going to put a 1 there. I'm going to click on cell E2, which contains a 1, and I'm going to close those parentheses. Okay, so what this is called is the forward PE. So I'm going to hit enter, and I'm going to select all these, and I'm going to just do a couple decimal places. The PE ratio currently is 35. But if I bought it today, a year from now, that will have been like I bought it for 30 times earnings per share, or rather 30 times PE multiple. So if we go back to the stock sector, stockanalysis.com, the sectors, the technology is 42, but that's like buying it for 30 in a year from now. And that's closer to the historical average of between 20 and 25. It's still high, but it's not, 35 or 42. Okay. So I want to say, well, what if I project that into the future? Okay. So first off, I want to make sure that the price of $14, or rather of $491 does not change. I want to make sure that the earnings per share doesn't change. And I also want to make sure that my growth doesn't change. So I'm going to put dollar signs around all of that. So I'm going to put dollar signs around the price, dollar signs around the earnings per share, and dollar signs around the 15%. There we go. Okay. So now when I click and drag this 5 years into the future, I see that if I bought Microsoft today at $491, that would be like getting it for a 17 PE ratio in 5 years. Now that's mighty attractive because again, the technology sector historically is between 20 and 25. So 17 would be well below the historical average. The thing is it has to grow at 15% every single year for the next 5 years. And we have to hold it for that time. Okay. Now, again, I like to be cautious, and so I'm not going to do this forever. What I'm going to do is say, well, at around year 6, I want that earnings growth to shrink a little bit. And so starting at year 6, I'm going to go back here. I'm going to multiply it by my scale down factor, which is half. Okay. And I don't want that to change, so I'm going to put dollar signs around there. Okay. And I'm going to go like this and drag it out into the future. And so if my earnings keep growing at 15% for 5 years and then 7.5% for the 5 years after that, in 10 years, it will be like I bought Microsoft stock for 16.94 times earnings. And so that, to me, seems kind of like a steal deal in the technology sector. Okay. So the other thing that you can do here is you can sort of clean this up. You can make it colorful. For example, we can make this boldface type. These things right here, we can, those are things that the user is going to input. So I can put those in a box. Actually, these are the things that the user is going to input. So I can put those in a box. I can put these in a box. Okay. Just making it more appealing to look at. I can just make all these bold if I wanted to. Okay. Since these are things that Google is going to scrape, maybe I'll highlight those and I'll change the color to something like this light cornflower blue. But the stuff that I want the user to put in, maybe we'll make that like a light yellow. What I like to do is I like to do conditional formatting. And so what that would do is say, all right, if this is positive, if we have a margin of safety that's positive, make that green. And if it's negative, make it red. So the way that we would do that is we would right click on that cell. We would go down to more cell actions. We would go to conditional formatting. Okay. And I'm going to add a rule that says if this cell B3 is greater than 0, we are going to make it bold and we are going to make it, let's call it light green. Okay. Now that handles if it's positive. If it's negative, we're going to add another rule. So I'm going to click on that cell, add another rule, and I'm going to say if this cell is less than or equal to 0, we are going to make it this light red. Okay, so it is positive, so it's not making it light red. Oh, we'll also make it boldface type too in that case. Okay, so it's not negative, so it's positive, so it's giving me a green color. But if I were to just manually put in like negative 10%, then it turns red automatically. So that's nice. I'm going to undo that so it stays that formula for the intrinsic value and the margin of safety. But there you have it. Again, we can make this a little nicer to look at. We can go like that and put a table around it. We can go like this if we wanted to. So I'll leave that up to you. I'm not too big on color schemes and whatnot, but that is how you do a very basic intrinsic value calculation for a particular company. It's automatically filling in a lot of the values. Some of these you have to sort of figure out yourselves. If this is too conservative for you, if a 50% drop in earnings per share is too much, then maybe we could do something like 0.8. So just reducing it by 20%. And that gives us a margin of safety for Microsoft of 25%. So that's a pretty healthy margin of safety if you think that it's going to grow 50%, 15% for 5 years, and then 12% for 5 years after that. Anything can happen. This is a lot of guessing. It's a lot of estimating. Tools like stockanalysis.com will help you. Finviz.com will help you to pull these numbers and see what you get. So if you got value out of this video, please like and subscribe. Share it with your friends. Let me know if you got any value out of it. And happy investing. I hope this all works out for you and that you can make very educated, well-informed decisions out there in the market.